right, so I will start. I'll go over some of the more recent trades. I obviously have not been trading the last week or so. Let me here, I'll shift this over here for now. So let's see here. Losing trades. So one thing I'll mention that I would consider, I'll go through these, but I do want to mention you want to avoid going too in depth with only losses because it really is part of it is part of the game being able to look at losses. And so I like that some of these are just unfortunate you have listed here, which is good because there honestly is not a reason for every loss. Like I've had picture perfect setups that lose, and if you find yourself trying to make reasons for all of that, it makes it very, very difficult to just be comfortable with the probability of things. Like for example, like I had a 4 trade losing streak here, but when I go into these trades, I don't know, skip verification. When I go into these trades, though, to me they're perfectly fine. You have to kind of be able to look at it from that probability standpoint and just understand like it's completely part of the process. Because if you go too in depth, like I could look at this trade here and maybe make up reasons for why it lost. I could say, oh, the break of structure wasn't clear enough, or oh, there wasn't a great liquidity sweep. But I feel like doing that too much is going to actually hurt more than help. We can go over some of those. This is some of the data I wanted to look over too. But if I am correct, I just want to check. These are just all losses within a backtesting set of data. But another thing I want to ask too is how did the full set pan out data wise? Like, was it a profitable testing session? Was it not as good as you may have wanted? Yeah, there's a good amount here. We could probably go through some of these, but if you do have a sheet that has the full data, it'll be something better that I can kind of look over. Because realistically speaking, like a trade like this, perfectly fine to me. This one, perfectly fine to me. So, in this one as well, a lot of these losses look fine to me. It depends on how your data pans out as a whole as well. Because if you only do focus on losses and how to optimize it, you'd be surprised the majority of trading is not necessarily optimizing losses. It's about number one, the probabilities of losses and wins, but number two, a lot of traders find themselves missing winning opportunities more than they find themselves optimizing losses. Because that's a big, big problem I see. For example, December had maybe 10 different winning trades, a ridiculous amount. Uh, and a lot of people found themselves missing almost all of them, which is the majority of the issue compared to something is I'm unsure how to get my data reviewed. Do I need to pay? Typically the way we do it now, you don't have to pay anything extra or anything, but I'll actually show you. So this is, for example, one student. I've had a lot of them send this type of sheet. So this is Sven's journal. He collects the data here. Well, this isn't Sven. This is another student, but he collects his data here. He logs it and then just sends it to me and asks me to look over it. So I'll give you an example in this webinar of how this is a fresh sheet right here that a student sent me and how I would break it down. But then the other option is FX replay. A lot of people send me FX replay data, but it needs to be accompanied by the images so I can go over it. Because the thing about it here is it gives me an idea of the bigger picture. If I, for example, only look at a sheet of losses here, it doesn't tell me, for example, you could have been profitable trading this exact way. I'm seeing winners on occasion here and there in the images, and doesn't give me the full picture of was this a profitable edge. If not, I can kind of dive into what things need to be fixed because I am seeing winners on occasion here just within that. And I can tell you right off the bat, like this winner, that winner, this one, and there was one more. Like even just those winners may have been enough to make up for a majority of the losses you're seeing here. And that's kind of the goal is you want to take a bigger picture view at all that data like this and see, okay, even after 81 different losses, all he needed was 36 wins and he made up for it and more and was 27% in profit. So that's really the way to kind of get into that mindset of like truly trusting what an edge is and what the probabilities are is someone might look at 81 losses and say holy shit, but the bigger picture here is even with the 36 wins he's up 27% on his account, which is significant. So it is something where you kind of do want to get a bigger picture there. And if you don't have the winning trades, I'd recommend next time you do a testing session, maybe go through, collect winners, losses, and break evens, because that's going to be the best way to test and see, how you would have been profitable or unprofitable in the bigger picture. Because some of these, so I have all the data. I just send the losers and trying to increase strike rate. So you'd be surprised. In most cases, increasing strike rate. Let me see if I can read this properly here, though. So it looks like overall, I just want to make sure I'm looking at this correctly. So it looks like overall, the RR gained here was 114. No, that's incorrect here. So strike rate of 31% at 3R. Yeah, this table's it's throwing me off a little bit. Oh, I see. So your net risk to reward, I'll point it out here. Yeah, 29R with 30% strike rate, you're already in a really, really good spot. So it's understandable to want to increase it. Which we can go through some of those losing trades kind of now that we know there's a bigger picture here. But I'll be honest, 29 RR is absolutely fantastic. I think that's even what I made. What am I up in the last few months here? I'm up 18R in the last 4 months. So 29R is not bad if this is the scale of a year or whatever it may be. And then over here, I'm trying to dive into what this might be. So 3R total trade with break even. So total BE wins, BE loses. So is this how many break evens would have won, how many break evens would have lost? Or is this okay? Honestly, that's pretty good stats in itself there, because the way that I would check this is if this number times 3 was greater than this number, the break-even rule might not be for you, but as you mentioned in this case, you did end up saving 16 risk to reward here, which is by far in your favor. So honestly, I'll be honest, this data right out the gate looks really good. The only thing I will say, and this is the tough part, obviously, and a tough transition, but when replicating this live, you just have to be used to seeing those losing streaks, seeing that you're going to have, 85 losses for every 38 wins. And it is just really part of that data you're going to have to get used to. We can look at some of these trades here, though, and I can see if there's any feedback that I would specifically give. Can I blow these up in any way? I don't think so, but so one of the things I notice with some of them at least was the break of structure. I definitely would want better breaks of structure in some of these cases, and this would be one of them. Control zoom, yeah, we could do that. This is better. So like this one, for example, I like the sweep that you have marked here. It's just a nice wick grab, very impulsive through the high. But when the break of structure is very, very small like this, it's one thing that typically has me avoid positions. And the other thing is you mentioned some ugly price action in some of these, which I would agree with, but this comes down to the break of structure again. So you mentioned it yourself, which is really good. And there is one more thing I want to mention regarding testing. If you do a testing session like this, I notice you already have some notes here. I would mention, so for example, you don't want to go too in depth and get too complex, but if you simply looked through this and added a rule based on weak break of structure, that alone can be something that increases your strike rate from 31 to 35, for example. So it is those marginal, tiny little changes that will make an increase. But I do want to mention you don't want to get too complex with it, because bullish trend potentially starting, previous extreme low is not broken. So once you start getting into too many details like this, it can honestly hurt more than help, because you'll find yourself taking less trades. Because another thing I do want to make clear, mathematically speaking, your win rate is actually the least important statistic as a trader. It's number of trades is most important. Your risk to reward is second most important, which all of us here trade the same. And then your third is actually the win rate. And this is because if you were a trader, let's just say everybody here takes 3 risk to reward by default. If I had a win rate of, let's call it 70% win rate, and I took 10 trades for the year, that means I would have 7 winning trades and 21 risk to reward, if you guys are following. So I'll toss some math in chat. So 10 trades. Sorry, my keyboard's really loud. 70% win rate. equals 21 RR per year, we'll call it. And then the other example is, let's call it 200 trades with a, let's say, well, in your case, a 31% win rate. So 200 trades times 0.31 times 3 is 186 RR for the wins. And then let me just do the rest of the math here. So you're looking at about 50 RR in this case with a 31% win rate equals 50 RR. So you can see even with a win rate less than half of that 70 RR, you're making double the risk to reward by taking an abundance of trades. Obviously, in your case here, in total, you took about 123 trades, which I would say is also in a very good ballpark. You're looking at like 10 a month there if this is over a year. So I would not be too stressed about win rate considering how you panned out at the end of the year, because realistically speaking, it's that marginal increase on the win rate from 31 to 35 that could change your data big time compared to trying to keep pushing it up to the 40s and hopefully aiming for 50. And because I do see a lot of people get too complex in their trading trying to do so. I might even make a video on it's called over refining is the term that we use. But the idea that if you dive too complex into certain losses, you might actually end up hurting your data, because let's say this became a new rule and it's going to narrow your trades, you could end up increasing your win rate to 40%, but then decreasing the amount of trades you take to 50, and that alone is not enough to make up that gap. You'd actually end up in the same returns at the end of the year. I do like some of these. I don't see too much concern. I think this one here, I do agree, very weak break of structure. It didn't come much below the low. Otherwise, I think this is a solid trade as well. Just want to kind of briefly go through, see if I notice anything concerning, which I honestly don't. A lot of these setups look pretty good to me. I can't really read this. Was looking for longs for some reason. Yeah, so I do think if you were looking for longs here, it makes sense, but I think one thing to keep in mind, Sven has a whole video on external structure, and if you kind of just follow from this low to this high, this low to this high, this low, and now we formed a new high, and then expecting another bearish move, so kind of following that that order flow of just lows and highs there is very good. It'll help you kind of stay on the right side of the market. Otherwise, a lot of these don't look too bad. Some of these weaker break of structures, though, I will mention, it might be better to, these weak liquidity sweeps when they're nearly equal lows. It's sometimes better to avoid those or be careful of them. But I don't see too much else. This one here is one that I would question, and the reason being is I don't see a very impulsive liquidity sweep here or an impulsive strong low compared to the range. So we broke a very large range high here, but we didn't necessarily sweep any significant liquidity. So that is one that I would probably avoid, especially with how low and slow the volume came in. So nothing too concerning, because honestly, I think the biggest key here is if this was your first set of testing, being able to look at this and write some notes like this and then go into another set of testing is huge. You will already probably see an increase on your win rate just from that. Because that's something that I've seen very often as well, is people will present me their first set of tested data, and before even, getting feedback or anything, they'll do a second test of data and actually see an improvement on it simply from very minor changes or just getting more used to and comfortable with the strategy. I think a lot of these look fine regardless. I don't see anything that stands out too much. They all look like pretty solid trades to me. Maybe a little bit of a weak break of structure here, like we talked about before. Sometimes too, I will avoid if price is like very sideways like this. That's another big one. I find those are two of my biggest issues I see when I look over larger sets of data. Is if there's consolidating price, this would also fall in that category too. Both of these are very sideways price action, and I find personally that the more you avoid that, the stronger your win rate will be as well. So trying to be cognizant of, like, if price is very sideways, avoid that. Maybe don't trade that setup or that pair, move on to the other ones. And I would say the same for this. We see very low volume here. Price is just kind of moving sideways. So despite the setup that occurred, it's very less likely for this setup to play out. Otherwise, a lot of these look good. Maybe another weak break of structure here. So I would say down to those two things, in my opinion, would be focus on, which you got it nailed in here anyways, but focusing on the weaker break of structures, maybe try to look for a little bit stronger price action above these highs and lows, like this one specifically. That can definitely help seeing those stronger breaks. And then number two would be try to avoid those very sideways trading ranges, because that'll save you from a lot of unnecessary losses by focusing on price action. Like even this one, see how price is kind of very sideways, not really breaking structure or trending or anything. Versus the ones that are a cleaner trend, you'll see a lot better of a win rate with those. Otherwise, though, it does not look bad, and I do want to go over, and if you do another set of testing, feel free to you could either do it in a journal format like this, make this a little larger. You can do it in a journal format like this. You can use FX Replay if you would like and log all the trades in there. I like FX Replay because I think it gives you a better idea of the live markets and kind of getting yourself used to that, how it might look, because you're just scrolling through price action versus anything in hindsight. It helps you make that transition from backtesting to live a little bit easier. But one of the first things I will mention here, so this student sent me this data yesterday. They mentioned that they felt like they were doing really good at first and then found themselves consolidating and kind of not moving or progressing at some point. And this is pretty important because as I go over this, if you guys would like, yeah, no problem. But I do agree with what you missed winners. Sometimes I'll notice missed winners in hindsight. May not even know. I think so. The thing about missed winners, in my personal opinion, if you find yourself taking all the losses and missing the winning trades, I find it typically comes down to discretion. You may be too picky with trades, too discretionary with trades, because even, for example, like this is a recent one. Obviously, you guys know I stopped trading, but this is one a student sent me, so I've been keeping an eye on that. Something like this to me is very, very clear. It's a trade where we had consolidating price. We swept these relative equal lows here, or these equal lows, broke structure higher, fair value gap, very strong break of structure. All of these things are very clear. The issue is some people might psych themselves out of this trade. They might go, whoa, price is tanking into my entry. I don't want to take it, delete order. They might, that's a psychological mistake. The other end of the spectrum is people may not have been watching the pair closely enough or looking for their setups properly enough. A lot of setups I found, like even USD CAD, this was one where I don't have it marked up anymore. Let me remark it up. I had this one sitting here for quite a while because price took a long time to come back down and into it. But this was another one where I made 6% on this trade, but it comes down to just trying to not be as picky with trades, because I do want to circle back to what I said. Your win rate is not necessarily the key factor here. It's the number of trades that's going to have your edge play out longer term. I could probably even make a whole video on the mathematical probability itself, but I do think it's important for some people. I just stopped trading because the holidays coming up, and for me personally, I have a lot of tax implications that come up towards the end of the year because I have a lot of different incomes that I kind of have to get sorted. And for me, continuing to trade and just adding that onto 2024 is not something I care to do. So, and especially the holidays too. For some of you that are like fully just swing trading to set and forget orders, like I think it's fine. Even me, like if I really wanted to, I could slap some orders on Monday and not really care about it. But for me personally, just peace of mind. I typically don't trade the holidays anyways. I've been trading for 5 or 6 years now, and I've never really traded through holidays. I typically start on January 2nd is when I'll pick back up. I wait through the holidays, through New Year's, and then January 2nd is when I'll probably start placing some orders again. But I think it's perfectly fine. If you guys, don't mind hopping on for 15 minutes on, during the week or whatever, placing your orders, I think it's perfectly fine. There's no issues with that. No problem. But back to what I was saying about the math, I do want to make a video at some point breaking down uh, how win rate, risk to reward, and number of trades kind of play off of each other. Because I do find that the people who try to be more conservative, although you will increase your win rate, you're actually hurting your edge by not taking an abundance of trades, because that's really what's going to play out in your data. I wonder if I can actually we'll maybe go over it if we have time at the end. I'll probably pull up the FTMO equity simulator. We can maybe take a look at that and play around with win rate and number of trades and kind of show you guys how the data pans out. But first thing I want to mention about this student's data, I already kind of went over it, but he said that he found he was doing really good at one point and then stagnated. And if you guys want to try to get into my eyes and take a guess at what I noticed here, feel free to send it in chat if you think there's something that you notice. But I will be honest, it is not something that is too intricate. It's something from a data perspective that I think is important to know. But I'll just mention it's not what meets the eye. We're not going to go through each individual trade, and you guys can give feedback if you'd like. But I think the most important thing here is to understand from a data perspective why this might have happened. So I do want to start by showing you guys how I first went over it, because I think the first most important thing for me is setting up a chart like this and getting an idea of what he said. Basically, was he correct about, he was doing really good and then started stagnating? So I go to insert, I add a chart here and put in a line chart, and then I click on data range, and I want to just copy all the data up to his last trade and click OK. Now if we go back up here, it looks like this. I have to adjust the scale, which minimum value, he started at 100K, and there we go. So I very quickly just tossed on this graph. I actually did it for him yesterday. I deleted it so I can do it again to show you guys, because I think it's an important metric to have here, because it allows me, your equity curve is basically the bread and butter of your strategy. Like, this gives you from the outside in how well you're doing. For example, if you look at mine, I like this because when you look at it from the perspective of, oh, I lost 4 trades in a row, it might look a little bad if you take off the end piece here and losing 4 trades in a row and being on a 4-trade losing streak. But when you look at it in the bigger picture, it really shows you that you still have that maintained consistent growth regardless of these deep dips within price action. 4 in a row is one of my worst losing streaks since May of this year, which is not on this graph, but I had a pretty bad month in May, not too great of a month in June, and then July and August was just a fantastic month to come and make up for all of it, similar to what we're seeing here. Not a great month towards the end of November, and then a fantastic December. So very, very common, but I think it's important. So what he mentioned was he found himself doing very, very good. You can see how consistent this equity curve is here. Very, very bullish. Even this section here is fantastic. The same way you can have losing streaks, you can have win streaks, and that's what we're seeing here. But then he mentioned to me he stagnated for a really long time here. Now, to me, when I see this, the first thing I have a habit of doing is dive into the trades and look what's going on. But I will mention for this specific scenario, all I did was kind of take a look at the bigger picture for now and dive into that. So the first thing I noticed, he's up 27%, absolutely fantastic regardless. 81 losses and 36 wins, which also that is pretty great. A 30, roughly same win rate as you, Dang, from the data that you showed me. He's sitting right about 31% as well. So both still very good data. I know 31% is hard for some people to accept that it is good data, but when you see the net gain at the end of the year and compare that to something like the S&P 500 that does half of this, you have essentially doubled the returns of the overall stock market. So keep that in mind from an investment standpoint, because one of the strengths as a trader is if you have the ability to double the returns of the stock market while having nearly no drawdown here. I think his lowest point of the account was, he never dipped below 100 grand. Imagine putting 100 grand in an investment, getting 27% return, and it never dips below what you put into it. Absolutely fantastic. And this is the type of goal as a trader is in the long term, if you have private investors that maybe want to invest in you. I mean, being able to take their capital, mitigate their drawdown, have very little drawdown, but gain double what the stock market can gain, anybody would take that investment. So that's one of the better ways to look at it. But what I did notice before diving into just trades, which we can go over a little bit, is I noticed that he clearly had great win rate and a great equity curve here and stagnated like he said. And then I started looking at the pairs. So you have pound JPY right here. You have NZD CAD here. Bit more trades on that one. Pound Chef, AUD JPY, pound USD, Euro CAD only had 1 trade, Chef JPY, And then I noticed Euro USD here, AUD NZD, Euro Chef, Pound CAD. You guys might think I'm a broken record right now, but then I scrolled down and realized that at some point, after switching pairs, maybe 8 to 10 trades per pair, he got to a point of Euro USD and just decided to test all Euro USD all the way down for multiple years in a row. So this was one of the first things I noticed, because what I want to make clear here is it's not that he stagnated. It's not that his win rate sucked and he stagnated because he wasn't trading properly. It's because he wasn't giving himself that bigger picture view of how the data truly works anymore. So when he was testing all different pairs at once, that's how this strategy is meant to be traded. It's very likely that a certain pair can perform worse than others over the period of, call it, 5 years, compared to when you take all 20 of the pairs that we trade, combine them together, and how that equity curve plays out, you're going to get something a lot more consistent and profitable, like the beginning of this, until he went and decided to stick to only Euro US dollar. And what that did is it basically said, okay, remove the other 19 pairs and how that would affect my data or more. I know some of us are trading 25, 26 plus. Um, but you're essentially removing how the data would be working in the live markets and now only focusing on how did it perform in those 5 years on Euro USD, which is not necessarily the bigger picture here. If I took my own journal and I deleted all trades except for pound US dollar trades, I would have a losing trade. Let's see here if I'm going to be able to even, I don't know how many, a losing trade, a winning trade, a break even trade, and that looks like about it. So if I pull that out, I have a 50% win rate. You start accumulating all the other trades and data, and it was about 58.6% with all of the pairs combined. So this is how the edge is supposed to be looked at to give you that consistency. If you accidentally go and test one pair for too much, you're going to end up hurting your win rate or not getting the overall picture of the data as a whole. So that is something very important to keep in mind. I know it's, kind of confusing, especially if you're not like a big data person like me, but I enjoy data and I always look for reasons for why something like this may have occurred before diving into individual trade by trade. But when I did look at a lot of his trades, nothing looked out of place to me. They all looked great. We can go over some of them here. So yeah, something like this, a great impulsive break of structure. We have the fair value gap right around that break level, sweep on liquidity, very, very impulsive win. Same here. This is very clear. We have a sweep on liquidity, break a structure, fair value gap right around the entry, price taps in, very aggressively runs take profit. Another one here. I like the sweeps that are just barely reaching above those highs. They break structure lower. We have a fair value gap here and a little bit up here. Price works its way in and then breaks lower. I think I might have taken this trade live. Not sure what year that was. August 2023. Yeah, it sounds about right. I feel like I took that trade. And then this one, pretty solid as well. Nice sweep on liquidity, break a structure, following that bearish trend too. Fair value gap right around entry. So a lot of these trades did look good to me. Nothing specifically stood out. But once again, going back to that idea I talked about of focusing on how you're testing is very important. I do think FX Replay is a good tool for this as well, because you'll notice when you test on FX Replay, you have to do it pair by pair, but then you can like click on all the pairs and say combine that data and look at the overall equity curve. And I think it gives you a way, way better picture mathematically of how your edge is playing out compared to just trying to test one pair for many, many years. If you do go in like the back testing channel, for example, here, we'll jump over here. Some of these sets of data, like USD Chef from 2020 to 2024. This is from Lucas, super early member. He joined us, right around when we opened, actually March. I think our first other student was in April when we opened it to the public. He's a friend of Andre. But USD Chef from 20 to 24, and compare this to the data that was collected from this student on Euro USD from 2020 to 24. You could see Euro USD was almost stagnant and break even. But if you combine that with another pair that did perform well at the time, already between those two pairs, you are seeing a profitable edge. And the goal is obviously just compiling all of those different trades together and seeing how the data really pans out as a whole. So, NZD Chef, maybe a little bit worse results to start, but still not a bad pair, and just essentially trying to combine all of those. Um, this is an interesting set of data. I kind of want to look at this because I did not see this originally. A little bit of a stagnant equity curve here. You would like to see a little more consistent growth, but overall ending in profit. And if you take that, they call it the line of best fit from the start to the end, you can see it's obviously an increasing line there. So some very profitable data. Currency pair, 3-1 total gain. So 16% gain, which is really not bad in the course of it. Looks like about a little less than a year there. Couple losing months as well. So nothing to be concerned of. This is the very important part of data, is really understanding that bigger picture. Like, this is very realistic for how a month or how a year might look, is winning months with a few losing months within there, and just overall coming out at that net 16%. Keep in mind, FX Replay has a glitch where they don't show the proper percent gain, but he said 16% based on his journal here. And I do think, coming back to the amount of trades we talked about, he did have a little bit less trades. So he only had in total here, it looks like 112 trades, which isn't bad actually. That's a pretty good level. NZD Chef from 2008 to 2014. So this is another good example where a certain pair over a certain period of years may not perform the best, but combining that with the other pairs, like we saw Euro USD and USD Chef, both doing pretty well over the same time period. Combining those together helps negate these pairs, and the goal is overall combining those to get that profitable edge. Not bad overall. I do want to take a look at some more of these. I went through a lot of his original trades, but once I kind of realized the issue data-wise, I didn't go through too many more because they all looked pretty good to me. But this is essentially all I do when I'm going through a student's data, is I will check and make sure the data looks realistic to me. Like, I want to see that winners are following the rules. They're not crazy winners that are going to be difficult to take on a live account. I definitely like seeing the equity curve, and I like seeing that overall gain. All of this data here is very, very important to see if a trader is doing well. And then lastly, I'll go and dive into a lot more of the specific trade positions. So for example, this one here, I would mention avoiding, and the reason being is drawing a angled line like this for liquidity can be good, but it essentially is having you ignore the equal lows that rest here. So you may draw the line diagonally so that it looks more like a liquidity sweep, which is fine, but you have equal lows resting at your stop loss, and you have price kind of working sideways. So I do prefer to avoid trades like that, because when working within a range, I've talked about it before, might be a little complex of a topic liquidity wise, but everybody from this point in time, let's call it the 19th of October, all the way up to, let's call it, maybe the 8th of November, everybody within this period of time has all of their orders inside of this range, because obviously if price is here, you can't go and place an order up here, down here, anywhere. It has to be within this consolidation, and that means a ton of stop losses and a ton of orders rest at the highs of this range and the lows of this range. If I want to buy price action in this range, I might put my stop loss at what people consider support lines or just strong lows, and same vice versa for people who sell in this range may put their stop loss above the support line here or equal highs. And all this is doing is building liquidity for smart money traders like us, but also institutions, because now what the institutions will do is, if they want to drive price very heavily lower, they need to enter a place in the market where there's enough sell orders or buy orders to do so. So if it took them, let's call it $10 million to go and make this sell move, there need to be $10 million worth of buyers in the market for that to be able to even be placed as an order. And that's called liquidity. So with $10 million of orders, it's most likely going to rest at the highs of the consolidation or the lows of the consolidation. So they drive price very heavily up there, converting those orders into the sell orders that they need, and then pushing price very heavily lower to grab the remaining orders at the low of the range. This is like a little bit of complex liquidity concept. I know if you got confused, don't worry too much about it, but I just want to make it very clear why consolidation is dangerous to be trading in, and it's for this specific reason. If one high of the range gets taken, more cases they're going to come and take that low of the range. This is why, we say avoid sideways price action, why we always say you know, these break of structures, they might end up being a fake break of structure like this and then just running lower. So try to avoid consolidation areas the best you can. Just fundamentally rooted in liquidity, it's a less probable area to take a trade. Nothing wrong with this one. It looks fine to me. Also, another pretty good trade. Another great one. This would have been a break even, I believe. Yep. This one's definitely a bit odd. I will mention just because of the size of the range here. Especially if I see price coming so heavily bearish down, and then I see a break of a range this large with very slow volume, I may avoid it, but still not a bad trade. I think that's another thing to kind of understand too as a whole. Let me put this back over here so I can make sure I'm not missing any questions if they come about. But one other important thing, just kind of like what I mentioned, is if you make 27% gain, there's 100% guarantee that in even my set of trades here, this is a bit of a smaller set, but there's going to be setups that I look at and I'm like, I should not have taken that one. It was a mistake. It's human error. Like, I can actually remember off the top of my head, pound JPY. This was not my best trade. Let me delete some of these. So at the time, I was seeing the bullish movement here on pound JPY. Realistically speaking, I was ignoring just the fundamental higher time frame structure. So mistakes like this are perfectly normal. And I want you guys to like understand that it's okay if you take a bad trade, if I take a bad trade on occasion, because you could see in that bigger picture, obviously, I may have taken a bad trade here on pound JPY, but when you accumulate that amongst all the rest of your data, it really is not that big of a deal. The issue is if it's a common occurrence or if it's something where you're consistently taking bad trades but missing the winning trades. This is when you really need to kind of dial in and focus on optimization through backtesting, obviously, or even practicing on live trading, really getting used to seeing those setups and taking them. But don't beat yourself up over bad trades because it's inevitable. I take bad trades and you guys will too. Part of the game. This one also is a bit odd for me, just because of the way price is forming here. It's not the cleanest ranges, but obviously it did work out in his case, so not bad. Same way a bad trade can take a -1, you can end up winning a +3 from a bad trade too, so nothing to complain about there. This one's pretty solid, pretty clear to me. Very impulsive wick liquidity sweep, break a structure down, strong break, huge fair value gap. This is a great trade in my opinion. See what else we got here. This one's not bad. I will say that the sweep is a little bit odd here, but I think regardless, it's a pretty solid trade. I feel like I may have even taken that one live as well. Okay, so this one is when you would really want to try and dial in on your higher time frame structure and just kind of get that bigger picture, because I would not consider this a very strong structure point. It's just a very minor pullback here. If you were to use the highlighter tool, which I think is a great tool to kind of help map out structure, you would see lower low, lower high, lower low, lower high, lower low, and then we break structure higher, assuming that more likely than not we're going to be bullish. So when in doubt, pull out a highlighter tool. It's this tool here for those of you that don't know. And I always just like to mark out my highs and lows. So like this, like this, like this. And, you know, based on that expectation, we're seeing higher highs and higher lows, breaks of structure. I can make that expectation of the next higher high. And then another thing to keep in mind too, I see this happen quite often. This is not an area that you mark out with the highlighter tool because this high has not been taken yet. So keep that in mind when you're marking it out. Because this high was never taken, this is not a range. It would only be when this high is invalidated. Now you have this range high to this range low, and then you kind of just follow those all the way up. And then when you're in kind of, in my opinion, I call this no man's land, where we really can't see any solid structure, avoid that pair. You know, just avoid the price action. Don't get yourself caught up in a very odd trade. Let it be. You know, I got to take a good winner off USD CAD, and I'll probably leave it alone for a little while now. It's another good one in my opinion. I like the liquidity sweep here. I like the break of structure. Super impulsive with a lot of fair value gap. Let me delete some of these so we don't get too This one's not bad either. I don't like holding trades for too long, in my opinion, but it kind of goes back to what we talked about before, where how do you know when, how do you invest when you're in no man's land? If you're speaking about long term investing, it's a little different. I'll talk about that in a second. I do want to make this last point here about because we did talk about it before. Having a liquidity sweep here is fine, but just make sure you're not ignoring equal lows or equal highs. Because I have seen this a couple times here where he'll have a liquidity sweep marked at a low, but then he'll have the equal lows right below it, just kind of, brushing those off or not focusing. But when it comes to investing in no man's land, in my opinion, like I always dollar cost average depending on the equity that I'm trading. So if I go to SPY, a good example is SPY just absolutely tanked today. And some people might be selling off shares or panic buying out of the market. But if you look at the last 4 hours, it has absolutely exploded bullish once again, just finishing a massive, massive percent return on my portfolio. I always focus on it. It actually technically we're in no man's land. If you look at it from the higher time frame like this, there's really no signs of pullback here, no signs of bearish momentum. Continue dollar cost averaging. I purchase every single month SPY and well VOO technically, but same fund. I purchase all of my equities in my investment portfolio monthly. I think you could do the same with something like Bitcoin. It's perfectly fine. We may look like we're in no man's land here too with Bitcoin because of how bullish we've been, but just continue that dollar cost averaging is your main goal. I would not change up the way I invest based on how price is moving. You would, if you're really long term on a certain pair or certain currency, dollar cost average is your best bet compared to trying to time it. Timing the market is not going to beat the person who just consistently invests. People who try to time the market too much, they end up sitting on the sidelines for too long with too much cash and just missing out on growth opportunity. It depends. So that's a complex question, and I kind of like that question because it brings up another topic. But the way I personally do it is, for example, on Bitcoin is something that I don't really care to hold to retirement. I do have some Bitcoin still, but when we reached all-time highs here, so I got into Bitcoin at 20K around this low level here, and it consolidated there for a while. I thought, it was a waste of my money, and then obviously we see it made a great bullish run. I took a large amount of profits, 50% at the high here, and then I have the remaining 50% just left to run, so that's done pretty well with the second up move. And if you really want to, you can dollar cost average. So that's a different scenario where if it's a fund that you don't have a crazy long term perspective on, I would recommend taking profits where you can. So I did end up getting to take good profits here, making I think it was like a 400% return on my initial investment. And then obviously we're still growing now with the other 50%. But when it comes to something like VOO or these long term funds that I do plan on holding to retirement, there's ways around selling it where you can still utilize the capital. And one example is taking a loan against that portfolio. So this is something you can do for, let's say you wanted to buy a property. Instead of selling your portfolio to go and buy that property, let's just call it, let's pull up SPY here so you guys can get an idea of what I mean. Let's say you're continuing to dollar cost average all the way up and you get to a point like today, and let's say you have 500,000 in this market. If you were to sell all 500,000 and buy a house next year, you make 0% returns on your investment because you're completely out of the markets. You have no capital left. You could take a loan against this portfolio of 500 grand, put a down payment on the house, put a large down payment, let's call it 200 grand. You still have all of this money in the markets working for you so that when the markets go and deliver on average 10% the next year, you're still making 50 grand on that capital and you own the asset of the house as well. So compared to just selling off a portfolio, paying the big tax on it, and then going to buy something, you're better off borrowing against that portfolio and using that. Of course, if interest rates align and stuff, is a little bit more complexity to it, but you're better off doing that and keeping all of your money within the markets so that you can actually, it's called arbitrage, positive arbitrage, when you keep your money in the markets, you pull a loan against it, and the markets in your investment actually outbeats the loan, and you make money by borrowing money. A little bit more of a complex topic, but I only bring it up because I'm very against selling capital. I think if you're investing in the markets, you should be continuing to invest until you have a very solid base built. Um, but yeah, it's because I do see that often where people may, for example, I know someone who entered down here around these levels, and then price got up to here. I think it was, right around this break of structure high, and they sold. And they completely negated their portfolio, missing out on one of the largest upruns in stock market history because of early selling. I have never sold any of my strong, like VOO, any of those funds I've never sold. And if you do have the need where an expense comes up, you're better off borrowing against that investment rather than selling off the base of your account. I know a common example of this is student loans. People might have a big investment account, they're building up, and then student loans hit. If student loans have an interest rate, I don't want to get too complex, but let's say student loans have an interest rate of 5%. The markets deliver an average of 10% per year. You're better off keeping your money in the markets and paying it down, paying that loan for selling your investment that's going to gain you 10% a year and just paying off the loans at once. Because now your base, which is all the money you have combined, is much lower, meaning you're going to make less in your investments year over year. It's definitely a complex topic. I don't want to go too in depth with it. I can maybe make a video on it too in the future for some people to kind of understand better, like just based on profit taking and stuff. But definitely, if you can, I would recommend avoiding selling because, especially in a great strong fund like VOO, which is what we're looking at here, you're gonna miss out on a lot of returns if you go and sell something like this early. Is there any other questions regarding? I don't want to dive too much. He has plenty trades here, so I don't want to dive too much into these, especially because I kind of already talked about some of the key concerns I saw with his positions, and then I'm obviously going to go and mention him about the liquidity and um the consolidation aspects of it because I think those are his two pretty strong areas he can improve, focusing on not having equal highs and lows at his stop loss and focusing on avoiding those sideways consolidation areas. Do I have? Okay. I was going to say if I had time to pull up the FTMO equity simulator, but I can maybe do that another time or in a video on the side. But is there any questions you guys have or trades you want me to look at before ending call here? Like I said, I have not traded in the last probably week and a half since I came back from my trip. So if there's any specific setups you guys want me to look at, it's probably going to be my first time seeing them. NZDJPY. Let's see what we got here. So this the bearish setup here. So I do think, once again, I would be wary of the break of structure here. I think overall, I love the liquidity sweep here. It's a very clear one. But you do want to focus on a little bit of those stronger breaks of structure. I think regardless, you might get away with that break even here. If not already, you're pretty close to it. But yeah, I do think focusing on a little bit of a stronger break is very important. I like that you're following the bearish trend, though. I like the liquidity sweep here, but yeah, seeing that a lot stronger of a break below it, that was something when we did go over your data, I saw occurring a good amount. And I think that alone, if you work on seeing those stronger breaks, could bring that 31% win rate up to easily 35. In Euro GBP, you mentioned too. Yeah, so I would agree. Same idea here where we're really just not seeing that strong break. Once again, though, I love the liquidity sweeps of this high and this high. I love the fair value gap at entry, but yeah, unfortunately, if this goes and runs TP or the other one goes and runs TP, at least you can look at it and understand that you followed your rules and you sat out of a trade that's less probability. That is really what it boils down to at the end of the day is having a stronger break of structure increases the probability, but that doesn't mean that this trade's going to guaranteed lose. It just means that there's a likely chance that is more likely to lose, and you don't want to be involved in those trades. You want to focus on the higher quality ones. But yeah, overall, they're both not bad setups. I like the sweep on both of them. I like the fair value gap. Everything is met. Even the trend is nice. But if I see a break like this, I definitely don't want to take the position. You might have lucked out with it in this case because of the break even. NZDJPY might be the same, but what do you think of highs like these? AUD, what is that? AUD Chef? Let's see. Honestly, these ones I don't mind too much. If you do take a setup like this, I have seen plenty of these work. I do think they would likely, I do think they would likely be lower probability just because these relative equal highs all along here. but I've seen plenty of these work, especially when you look at like a higher time frame, just kind of following within those ranges. It's not a bad setup. Um, but I would say it's definitely a bit lower probability just because of all that liquidity. There was one setup I saw. Yeah, this one for me is one I really like. I love setups like this where we're trending heavily in one direction and we just kind of grab through liquidity and break up. About to take an L on USD Chef. Let's see. This one here again, I would say is a little bit in the same boat. The liquidity sweep is not the best here. I've seen them work too, but still something I don't really like taking. Yeah, I completely agree. It's kind of the boat I'm in where if I see like a lot of consolidating lows or highs, yeah, no liquidity sweep. I would agree, no liquidity sweep here. But if it's a lot of lows and highs that are just consolidating around a level, I forget what that was, AUD Chef maybe, but yeah, like this, if there's a lot of highs like this in that area, I tend to avoid it. Simply just from a liquidity standpoint, I understand how many orders are resting in this area, and what you might even see in some cases is price will work its way up, grab that liquidity, and then drive lower, and it's just a frustrating example in itself. Um, USD Chef, I would say, yeah, the liquidity sweep is definitely lacking a bit here. I don't mind it, not a bad setup, just because following structure like this, but yeah, definitely a bit more aggressive for my liking. Any other setups you guys are looking at? Let's see here. I don't see too much else. This was another one. I didn't really like this one because no liquidity sweep, but I saw some people have that one. Waiting on NZD Chef. Let's see. Yeah, that's not bad. I like this one. So you can see here, much stronger break. We're well below that low. We broke it very heavily. I love liquidity sweeps like this, where there's a nice, strong, significant high here. Price grabs just above it and then breaks lower. So I think that's a good setup right here. Looks good to me. Obviously, we want to see if price works its way back in. It could continue just going bearish, but we start seeing price retrace. I think it's a pretty solid setup to take. Anything else? This one was one I saw last week, tapped in and TP. It was a little bit aggressive for me, but I also haven't been trading. I think someone else I know profited on this one too. Same thing. These very short-term reversals, not bad. Don't see too much else. This one isn't a bad setup either. Sweep of liquidity, break a structure, very aggressive break. If that is all though for setups that you guys want me to look at, I might wrap it up here. What time is it? 12:59, right on time. But yeah, I'll probably wrap it up here. I have an appointment to get to around, I think it's at 2. So this will be posted within the next 15 minutes or so. Um, yeah, no problem, guys. All right. Yeah, I'll get this posted in 10 or 15 minutes. I'll message the server when it is. And thank you guys for joining. Yep, no problem, guys. Have a good weekend, too. See you next week.